Welcome, everybody, so much to this amazing conversation with Charles Harris. Shane Dorian is co hosting with me. We just came off of another 30 minutes with just so much value. Charles was sharing with Shana and I his experience with Tesla, and we'll do a little recap. But ultimately, this is going to be an hour-long conversation, truly a part two to part one that we recorded last week. So please be sure to check that out. And if you're a fan of Charles Harris or Shane Dorian or me, please do share this conversation that's happening right now with all your Twitter followers to bring the people that are interested in this topic into the conversation. I'm not going to give the formal bio to Charles Harris or to Shane because I did that with part one. So I'll ask you guys to reference there. But we'll just make Shane just speak to just, what Charles just walked us through, and then where it's best, even for you, Charles, to continue that conversation. And you both gentlemen will have to unmute your mics yourselves.
There we go. Can you
Perfect.
hear me okay?
Sure can.
All right. Thanks, Kim.
Sure.
Yeah, can you hear me okay, Kim?
Clear, crystal clear.
Oh, cool. Okay, yeah. Well, morning, everyone. So Charles, you were just taking us through your thinking and a really cool PowerPoint presentation about Tesla and how you have a precedent in Apple from kind of like 2003 or 2004 up until the present, and how it's very similar to what we're seeing kind of unfold in the story and the stock performance of Tesla. So yeah, I guess just continue that here. It would be really cool.
Yeah. Really, I've changed my style a little bit with regard to how I'm trading Tesla. Again, I've always been a swing trader my whole career, with the objective of trying to just compound my gains as quickly as I can, and that works great. I mean, it's been a great career, but trading actively like that, constantly, pretty much day in, day out, it does take its toll. And in those rare periods where you find a super winner, if you can just get a big piece of it and hold a core, and really ride out what can turn out to be like one of those monster stocks, I think that's where you can make real life-changing moves. And if you really look at, Bill O'Neill's career and how, where he made his big money, it was really in just a handful of huge winners. Like Syntex, which was a developer of the birth control pill in the 60s. He made huge money in Pick and Save during the 70s and Price Company, which is now Costco. He made huge money in Amgen, I believe it's around 1990, when they came out with their, I guess, their therapeutics for to boost, I think it was white blood cells, cancer treatments. So, if you can, and again, we made huge money in Google, we made big money in Apple, but really you don't need to, 100 stocks to trade well to make huge money. You really only need to parlay a few huge winners together to really make literally a fortune. And so it doesn't come, these monster stocks, they don't come around all that often. And when they do, oftentimes we don't identify them quickly enough. So in those rare times when you come across one, you identify it, and you build the conviction early on, you don't want to mess it up. And so, for me, having done well in Apple, back when the move started, and again, I made hundreds of percent on the stock, but nothing compared to, tens of thousands of percent. And
Right.
And so I almost feel like I have a very clear vision of what's going to happen over the next decade. And it almost surprises me every day, when, Tesla's really been through this, gone through this kind of sideways, pretty tough period now for about a year and a half. And it's, consolidating huge gains from 2020 still. Um, but I feel like it's almost on the cusp of people are starting to really figure it out. And I think there's going to be a lot of good things happening. And, you know, even in today's market, I mean, the stock has, given the the performance of what's happened in the speculative growth area this year, Tesla, I would say, even though it corrected about 50%, did pretty well compared to, the Shopify's of the world and PayPal and Square, stocks that were down 75, 80, 85% plus. Tesla, I think held in there as well as, some of the better ones. But it's been tough. It's been really tough. I can't lie. This has not been a good year for me because I maintained my, an oversized position that I actually, had to sell some because it was just, it was too much. And I think I mentioned I got a margin call. So no one wants to admit to that, but it happens. So anyway, I don't
I
own
think
as much as I did, but I still have a huge position, and I think that I'm hoping the second half starts us off, something better than the first half.
very cool. I have a follow-up question, if that's okay.
Yeah, of course.
It's kind of in two parts. So, number one, like if you study historical market winners, a lot of the true market leaders in one cycle will not lead in the next cycle, and anybody going off that sort of thinking really missed this last really big bull market in Tesla, because it had a massive run right before the COVID crash, and then it went down like 60 or 70% in that crash, which was, to me, it looked like it had a big climax top before the drop. And then it fell so much that it was a little bit off my radar. And I was kind of slow to really realize it was really showing a lot of relative strength. And then I kind of mishandled that next whole, I mean, I got a piece of it, but, so I guess two questions is like, how did you realize you really had still a lot of conviction after that huge drop during the COVID crash? And then the second part really is, I'm looking at it right now on a monthly chart, Tesla, and it's been sort of basing for about 9 months now, and the relative strength is starting to look really good. It's starting to look a lot better. It's really kind of handled this bear market pretty well, considering the move it's had in the past. And I guess it would be just really cool for you to talk about the precedent with Apple, because if you didn't use charts and if you didn't study past historical true market leaders, you would think that there's no way that Tesla could double again or triple again or go up 10x from here, because it just looks like it's come so far, thousands of percent. But when you use a precedent like Apple, it's really important knowing that it still could be really early in its move.
Yeah. Well, yeah, I mean, that's the point of trying to find monster precedents and realize, I mean, there's not very many stocks that can lead for 2 decades like Apple has. And I remember one of the reasons why I lost my conviction was that, when Apple started its move, it maybe had a 20 or $25 billion market cap. And again, this is pre iPhone. And, as the company started to move up and, went up several 100%, they were now larger than Hewlett Packard and larger than Compaq and larger than all these other computer makers put together. And I was thinking, well, that doesn't make sense. How can this little niche player that has, 4 or 5% market share be bigger than all of the other computer companies? Like, it didn't make sense to me. And so I thought, well, this can't continue. And, I bailed out much earlier than I ever, I never thought the stock could turn into what it's turned into. And that's really the same story now going on with Tesla. Their market cap is larger than, the next 5 or 10 auto companies put together. And their market share is a tiny sliver of, whatever, 1 or 2% of cars. But you can see that we're beyond the tipping point. EVs are taking over in a huge way. And just like that Tony Seba photograph of the New York Fair when the automobile took over the horse and buggy, that is what we're in for over the next decade. That is how quickly the adoption is going to be. A lot of the legacy automakers are saying that by 2030, half their cars are going to be electric. Or I don't think they realize that. I think 10 years from now, you won't be buying ICE vehicles. Everything will be electric. And so Tesla is the only company that's ready for this. Other than new electric, like a lot of some of the Chinese makers that have no legacy business, and they were created as EV companies. I think that is really where you're going to see the leadership. And again, I think Tesla's going to lead. So it almost, to me, just looks like it's exactly playing out kind of the way Apple did, except that Tesla's got multiple markets to sell into and that they're creating. There was no, Apple did not create the smartphone, but their take on it was revolutionary. Basically, having an app store where your phone became more and more valuable and more useful over time, as opposed to all other electronics that lose functionality and lose value. An iPhone actually gets better. And that's similar to Tesla, to the car. The car actually gets better over time. They send you updates over the air. They send you new features. So your car becomes more capable. And once they figured out full self-driving, which I have every confidence that they eventually will, I think that's going to be a complete game changer. So yeah, using the Apple precedent, that's really been a godsend for me. Again, assuming that I'm right and that things play out that way. Tesla's still at the very early stages of this EV adoption. I mean, look, they've got a teeny weeny overall market share, but last year, I think in California last month, or I heard the stat on CNBC that they've sold more Model Ys than I think any other model of car, EV or ICE vehicle. So I mean, it's interesting. A year or two ago, I used to drive from. I had an apartment. I was going back between a house and an apartment, and I would count Teslas on the way home between residences. And maybe I would count 5 or 10. I was always trying to find more. And now I find 5 or 10 in 2 blocks. In the community I'm currently living in, it seems like every third person owns one. So I mean, we're seeing the adoption right in front of our eyes. And I know we're in California, where this is really the hub of EVs, but it's it's going to accelerate, and I think an astonishing pace. And I think it's going to catch a lot of people off guard. I think it already is. So yeah.
For sure.
So to answer your question, Shane, yeah, the stock has been consolidating all year during really this has been a devastating period in the market. Maybe not so much for the averages, but within, kind of underlying the averages, the growth sectors have really gotten creamed, as bad as they've ever gotten hit. And so the damage was much more severe than the indices kind of represented. I think a lot of that is because there was so much rotation during the year into different sectors that did hold up better. Like, for a time, energy was, oil stocks, energy stocks are doing very well. Material stocks are doing well. Some of the industrials are doing well. Shipping, transportation stocks are doing well. So, I mean, there were places to hide and places to benefit, which I think masks a lot of the damage to the growth sectors. So, all in all, I mean, I agree with you. I think Tesla's consolidating. The earnings are still ramping, and they're showing no slowdown in growth. At least no slowdown. Kind of given kind of their pure growth. They last quarter, they weren't able to make cars in China, which is one of their primary factories due to COVID. So, but that situation's now being repaired and changing. So, yeah, I think people. That's why that Apple chart. If you pull up a monthly chart of Apple, any of our listeners do that, you can see that you're going to have some dormant periods in there, but on a stock that can become fully dominant in multiple sectors, it's going to take more than 1 or 2 years for that to play out. Huge monster growth stocks take many years to ultimately play out. Whether we're talking about stocks like Amazon, which has been a leader for 20 years, Apple, Visa, Mastercard, these types of stocks can lead for a long, long period of time. And that's not to say that there won't be other stocks that perform better in any given year. But again, how often do you come across a stock that you have so much conviction in that you believe that even if it goes through a pullback or a correction, that it will come out of it? It's rare to have that much conviction. So when you have it, you have to play it in a big way.
Shane, I know you have more questions for Charles. I just want to, for those who are coming into the space, I just want to give you guys some context. I discovered Charles Harris personally. I had not heard of him before his Trader's Journey talk, which was a IBD level 4 master's program that he did back in 2019. If you haven't listened to Charles's talk, please do yourself a favor and listen to it. His vulnerability, his honesty about his journey as a trader is just really palpable, and I really felt it was going to be of value. My focus, of course, is on the mindset, the emotional intelligence for traders. My team and I at the Wall Street Coach focus on that. I felt Charles spoke to that in such a powerful way in that talk. We did do this part 1 last week, so be sure to catch that. Today we're getting a little more granular, thanks to Shane Dorian being here because of his own experience as a trader. And Shane, I know you had other questions for Charles around his Trader's Journey talk. I'm curious if you'd be willing to ask some of those, and then we'll ask some of the public traders that are in the room to ask their questions.
Yeah, I guess it really does play mostly into the mindset. As we all know, as traders, it's such a huge part of the formula of being a successful trader is having the right mindset. And for me personally, and I'm sure a lot of the listeners on here can relate. Like I've had multiple times when I've developed incredible conviction in a company, Tesla being one of them, Apple being another one of them. My personal super short story is I bought the original Apple click wheel iPod in 2003 or 2004, and the thing changed my life. Like all of a sudden, I had 100 CDs worth of songs on this little thing, small my phone, and it was a complete game changer. And I bought Apple stock that week, and I held it for like 3.5 years. And during that time, I discovered the CanSlim system, and then I had so much conviction in Apple stock, but I ended up starting to trade it a little bit too much because I didn't want to lose my gains. Anyway, I guess my real question is, once you develop real conviction in a game-changing true market leader like an Apple or a Tesla or like an Amazon or a Google, like one of these like emerging great American technology companies, um, how to hold for the long term. Like for me, holding anything longer than like 8 weeks is a huge win. So like once I held Amazon for 18 months, and that was like a game changer for me. It was one of my biggest winners of all time. And I guess for me the question is, how do you develop holding power once you have real conviction in a stock when there's a lot of volatility in some of these technology names?
Yeah. So first off, up until this year, I've never had a long-term capital gain in 25 years of 25 plus years of trading. Um, so this is new for me. Having the conviction to hold for a long-term capital gain is completely new for me. And again, I will say that I don't really consider myself a great long-term stock picker. I mean, there's been many companies that I believed have been, the real thing, and they never played out to be, to be that. I think that's one of, I think, Bill O'Neill's gifts was he truly was a great stock picker. And again, you only need a handful of those to change your entire life. So, one of the benefits of trading and particularly being in a shop like at O'Neill's is that we have the benefit of um, the resources to study the biggest winners of all time. In fact, our entire system and methodology is based on the biggest winners over the past century. So that is one thing that's very helpful. And again, like finding precedents and similarities to guide you as to what is the true potential of a stock and what can happen in some of these moves. So one thing I do is I keep a, a kind of a notepad of like a Word document of why am I holding this stock? Why do I have conviction? Because you're right, in the heat of the moment, when your stock corrects, 30 or 40%, and it looks terrible, and maybe the news is bad, we have a tendency to react emotionally instead of look back and see well, why am I in this to begin with? And so I keep that handy, and I refer to it and I say, oh yeah, these are all the reasons. Has anything changed? Well, no, actually, they've only gotten better. And so that is one of the things that keeps me that's kind of keeping me going. And the fact that, I mean, I did get in early. I was fortunate enough to get in early and make a great deal of money on the stock. So even with the stock, down, let's just say 30% off its highs, I've still I'm still I'm still in a different place than I was a few years ago. So I have some cushion to withstand this kind of damage. But yeah, I think it's you just have to remind yourself and keep going back to your notes of what is the basis for your conviction. And that this kind of holding a big winner, it only works if you pick the right stock, right? I mean, if you pick the wrong stock, you're not going to do too well. So it's
Yes.
so, and again, I can't say that this has been a successful strategy for me over time, because again, I've always been a swing trader, and I've always been successful doing it. But again, it does take its toll, being an active trader day in, day out. And again, I wouldn't recommend this for any old stock, only for the ones that you truly identify as ones that have the potential to be something really special. And hopefully you're right on it. Again, I haven't had a great record of that, other than other than Tesla, most of my biggest winners were really, trades that maybe lasted, 6 months to maybe a year. I did very well in home builders when the market turned in. Let me see, the peak was around 2005. I think that trade started in around 2011. I made a great deal of money looking for a turn in housing, and that was a trade that was over 12 months. Um, but no, usually I would say the way I've been successful in the past has been swing trading, many different stocks, taking 20% out of this one, 30% out of that one, and compounding my gains that way. And it's great, but um, again, you have to be on all the time, and you're going to pay a lot of money in taxes. In a taxable account, it's really hard to get ahead when at the end of the year you give half of it away. So yeah, this has kind of been a different situation for me, and my plan has been to kind of hold my core position in Tesla, and if I'm right, and if it continues to work over time, as I build equity in my account, that allows me to swing trade other stocks. So it's not my only position, but it's the only one I'm handling in this way.
Thank you
Gotcha.
so much, Charles. Um, just for context, Charles is a portfolio manager at O'Neill Capital Management with over 20 years of experience in finance. His conversation talk, A Call to Trader's Journey, is just an incredible eye-opening talk about just the costs that traders pay on an emotional level, and also just on a physical level. And I wonder, Charles, if you would just talk about what it's been like since you released that talk for you, as you've heard from traders. What is it that has surprised you the most about the responses you've received?
Yeah, thanks for that, Kim. But I should also make one quick correction. I'm actually technically a portfolio manager at O'Neill Global Advisors,
Oh,
as opposed
thank
to
you for
O'Neill
that.
Capital Management.
Yes.
Yeah, the response has been, incredibly gratifying, because I think we can all relate to making mistakes in the market, and having drawdowns and losing our discipline. Um, it it's hard to be a consistent winner in the market, and I can't really say that I've been a consistent winner in my personal account. I've gone through long periods of great performance, but I've also had a number of very large drawdowns that have taken its toll, and I've done really well over my career, but had I limited some of these drawdowns, uh, I would have avoided a lot of emotional pain, and my pocketbook would be quite a bit bigger. So it's been good, but there's certainly room for improvement, and I think everyone can relate to that, because we all want to be consistent winners in the end. And the very elite traders who can be consistent year in year out are pretty rare, but we can all do it. And I think one reason why maybe the presentation resonated with people is, one, people can relate to it, and two, it gives a little bit of hope, because this wasn't the first time that I've had a big drawdown. And I mean, I've never had one as big as the one I shared in the presentation, but I have had other drawdowns that were pretty serious, and I've always been able to come back and reach new heights. And so there's always that possibility to improve and to learn and to come back, as long as you maintain a stake and eventually cut your losses and calm down and regroup. So the market's always there. There's always going to be opportunities if you're in the right frame of mind. And so the market can, in a way, is very difficult, but it can also be forgiving in a way if you can kind of control yourself. So it's been a really positive response. I've really appreciated people's, what people have said. It's been really nice.
You say in that talk, there's a part where you talk about reflection, awareness, and growth led me to this. So, of course, I'm an advocate, and comes as no surprise to you, that I think that reflection and awareness and growth is the foundation of any successful trader. What do you think stops traders, even sophisticated traders, from realizing the importance of that self-awareness, reflection, and growth?
I think I think we have a tendency to focus more on, when we're going through a difficult period, on what we're doing wrong, because that's easy to figure out what we're doing wrong if you do a post-analysis. And you usually find that you repeat a lot of those errors. But I think what we don't focus on is why do we keep making the same mistakes? Why do we keep revisiting those errors? I think I mentioned last week that, when I look over my trading notes over 20 years, I kind of keep a trading journal at times, and I keep reflecting and writing the same thing to myself in all these periods. So the question is like, well, why? I knew what rule not to break a long time ago. Why do I keep breaking this rule? And I think that's really where we need to sometimes spend more time. And I think for me, what I talked about in my presentation and upon a lot of reflection was, I think I, in a sense, unconsciously sabotaged my own success because I didn't feel worthy of that kind of success. I mean, that's how, that's what I came up with for myself. I think we all have our own demons, and there might be different, things behind why other people make errors or make the same errors over and over. But I think a lot of people have limiting beliefs about themselves that prevent them from having super success in the market, or prevent them from getting beyond a certain point. I mean, you hear often that there are investors or traders that, they can trade great up to a certain level, and then they can't seem to exceed, some upper limit, maybe whatever that number is, they they have a difficulty getting over it. And you should never, theoretically, there's no reason why you can't just keep growing and growing and growing. So I think these are all internal limiting beliefs that we have, and having an awareness of, what you're doing, and maybe why you're doing it. It takes a lot of work. I mean, for me, working with a therapist is how I kind of learned a lot about myself and my motivations and my own limiting beliefs. So I think we can all can come from it from a different place, but again, focusing on why we're doing things as opposed to what we're doing wrong is more important, because again, the what we're doing wrong is easy. I mean, I think I said this in the presentation, if all it took to become a consistent winner was knowing what to do and what not to do, it'd be simple, because the rules of trading, the fundamental rules of trading are pretty simple, right? Cut your losses quick, ride your winners, trade in line with the market. None of these that's not brain surgery to be able to follow these rules, but knowing them and following them consistently, without any hesitation, and with a conviction and courage and confidence, to do it right. That's the the mindset you need, and that's what's having the right psychology and the mindset. That's what separates the elite traders, I think, from everyone else.
Are you okay to stay with us a little longer for us to get some questions from those who are our listeners? Okay, thanks for doing that. You too, Shane, you're okay to stay. I think his microphone is muted. Hopefully, Shane, you can stay too. Just to give you guys some context, this is a part 2 conversation with Charles Harris. Shane Dorian is co-hosting me. Shane is obviously very famous for being a big wave surfer, but he has also been over, how many years has it been, Shane, that you've been coaching for? I'm sorry, been trading for?
I've been trading the CanSlim system since 2005.
Yeah. So what we did last week, if you guys missed it, we did part 1 with Charles, talking about his amazing conversation and presentation called The Trader's Journey. And I strongly advise you guys listen to that, because it's really an incredible hero's journey. It's a trader's journey, but it's your hero's journey, Charles. I'm kind of curious if anybody listening to us here has questions about what Charles talks about in his trader's journey presentation, or just for Charles in general, around his mindset and how he was able to handle such an incredibly huge loss and come back. I think that's worth a lot of time and effort for every trader to pay attention to. And you being so honest, Charles, is pretty profound. So thank you for being so honest in that presentation. We have Jade here, and hopefully, Jade, you can hear me. And please ask your question for Charles.
Hello, can you hear me okay?
Yep, we sure can.
Okay.
Yeah.
Hi Kim, thank you for the platform, and Shane and Charles for the knowledge that you have imparted. So I have two questions for Charles. First is do you think that the characteristics of a trader which help him or her achieve crazy returns are the same characteristics that would make a trader lose a lot or become a bust? And then in the second one is in a bear market correction or sideways market, do you believe that a trader that mainly trade on the long side should avoid the market to save mental capital, adapt and be able to trade on the short side, or trade in a small position relative to his or her normal size to get a feel for the market and be quick to know if it shifts again? Thank you.
Thanks, Jay. Those are good questions. Let me start. Let me do the second question first. Yeah, I am primarily oriented toward long positions, and they say that traders are imprinted with how they first made money. So I started trading in the 90s, mid to late 90s, which was, in the midst of a great bull market. And so I made money trading alongside. I have friends who are traders who are made their first killing in the market on the short side, and it seems like they're always looking looking for bear markets. So I think it's natural to kind of move toward where you've had success in the past. Jesse Livermore said it's not the bull side or the bear side, but the right side. So we should all be flexible enough to trade on the long side and trade on the short side. But I don't know very many people that do that well. Even Bill O'Neill was primarily oriented toward the long side. So to answer your question, I think if you have the mental flexibility to trade both sides, then I think you can have success doing both. But I don't know a lot of people who've been able to do that. So I think I would specialize in what you're good at, and if you're good at the long side and making money in bull markets, then I think taking a break when the market's in a correction or trading really small is probably the way to go. Trading long with size in a bear market is not going to be a successful strategy, because you're putting the odds against you, and you're going to have many more stocks that go down than go up, even though the setups might look the same when they start out. The odds are just not in your favor. So anyway, I think that might answer that question. And your first question had to do with the characteristics that make someone be able to have, some profound success, making big returns. Are those same characteristics that maybe might cause blow-ups? That's a really interesting question. No doubt, in order to have really big returns, you have to be willing to risk. But I wouldn't say you're willing to gamble necessarily. I mean, you can, if you have discipline and rules and sell rules, you can mitigate your risk. So I wouldn't say, just going all in on something on a whim is, that's not going to be a successful strategy over time. But no doubt, I mean, the very, very successful traders that I know who have had, triple digit or larger returns over multiple years, have traded in pretty big size and aren't afraid to trade on margin. And I don't necessarily think that it's like a foregone conclusion that if you trade with that kind of risk and size, that you have to suffer a huge drawdown. It's just that when you're having that kind of success, it's very easy to kind of, for your ego to get to a point where you just think you're invincible, and you begin to relax those rules and relax your discipline, so that the market kind of clobbers you over the head until your ego shrinks back down. But I don't think it's necessary. I think one of the things I talk about when I used to give a presentation on trading psychology is, if I log all my trades, and I could see, when I start going from, a huge winning streak, I'll see in the loss column, multiple losses. And if you can, I always say, if you could stay within maybe 15% of your all-time highs, or at least get off margin when you're 15% off your highs, you probably don't have to suffer such a huge drawdown. I mean, the causes of my big drawdowns are really a lack of discipline, and really breaking rules, and that I knew better, but I just thought I can get away with it, or just I didn't appreciate the risk I was taking. So I think you can have huge returns and without having gigantic drawdowns. I mean, you're going to obviously have some drawdowns, right? If you're concentrated and on margin, yeah, you're going to have drawdowns, but there's a difference between a drawdown and a blow up. So I think they're mutually exclusive.
Anybody else have any questions for Charles? Just raise your hand and I'll get to you. Shane, what were some of those other questions that you had that we weren't able to get to in the podcast, which we recorded before this Twitter space? So please, everyone, keep an eye out for this full interview that I'll release next week on my podcast called The Wall Street Coach.
Yeah, Kim, are you asking me?
Yes. Yeah.
Yeah. If no one else has a question, I guess mine is a little bit less about mindset and more technical. Charles, this is our first real bear market in quite a long time. I mean, the COVID bear market was technically a bear, and it was pretty savage, but this being our first real sort of longer real bear market, and for especially technology and software and some of the names that we tend to focus in, it's been a horrible bear market for a pretty long time now. And I get excited in bear markets because all the the future leaders start setting up, and we start seeing themes and sectors showing relative strength, that we see big volume, starting to come into those sectors. I just was curious if there's anything that's on your mind as far as like then if there is going to be a next leg up in the next couple of months or the next year or whatever it is. It could be tomorrow, right? So I guess I'm just curious. I'd like to know if you're seeing some sector themes, that are exciting going forward besides Tesla.
Yeah. Yeah. I'm. The composure of the market is changed a lot, and I mean, honestly, I've been kind of bullish all the way down, because the secondary indicators have been showing signs of being oversold for months. And so I've been surprised by the weakness. And again, I've been hurt, just holding Tesla, has been painful. And I never imagined we'd have the level of damage that we did have. But I mean, like, this is just my opinion, but I think the levels, the contrarian indicators were so oversold, over these past 4 or 5 months, and I think that we may have seen the lows in the market. I wouldn't be surprised by this. Is again my own personal opinion. It's not the firm's opinion or anything. It's just my own personal opinion. It won't be surprising to see a retest of at least maybe the 50-day moving average, but I don't think enough people bought into the fact that things have been getting better. So I mean, I will not be surprised if we can continue to move up. We're still below the 200-day moving average, so that's going to offer some resistance. At least I'm looking at the NASDAQ right now. So that might be an obvious area of resistance, whereas the 50-day moving average, which is now trending up, will be an area of support. So those are the things I'm looking at technically. With regard to like kind of individual sectors or stocks, yeah, I mean, you're starting to see stocks, break out and, in the growth category. And so, like, some of the stocks I've traded in my own personal account, other than Tesla, have been Celsius, CELH, is a stock that I own in my personal account that I like. Shockwave is these are like kind of the early breakout stocks that showed you know showed strength in poor market conditions, that were the first to lift off and break out post follow through, and those are places where you often find your next big leaders. So so I and there's quite a few stocks now. It's not that hard to kind of create a screen and come up with a lot of stocks that are near proper pivot points or have already broken out, and maybe I'd be looking for pullbacks to maybe to either add positions or even initiate positions if you missed them. I'm still, I don't know that I recommend going full force. At this point, a lot of stocks are getting a little bit extended. So you always want to have that discipline of not buying extended from a kind of a proper pivot. But there's plenty to put on a list, and I think, it's hard for those who have been sitting in cash waiting for the opportunity. It's always hard to get into the market after a bear market, and this has been a pretty bad one. Particularly again, as you mentioned, in technology and software. And so, if the rally's for real, and we have seen the lows, and maybe we're on the cusp of a serious uptrend, there'll be time to get into the markets. You don't need to get in on that first day. You don't need to be pushing too hard right at the beginning. There'll be time to get in and to find leadership. So, but you do have to take that first step and take a risk. I mean, there's no there's always risks that you're going to lose. So I say put your toe in the water, get started, get a few wins under your belt, get your confidence going, and then try to find those stocks that you believe have the potential to really be something. And those are usually, the first ones to pop up are the ones with the highest relative strength and that have the N in can slim, the new. They've got a great story. They've got a new product, a new service, something that's defensible that no one else has, a first mover advantage, um, a big market opportunity. Try to
That's great.
identify those.
Thank you so much, Charles. Just context, this is part two, guys, of a conversation that we're having with Charles Harris. Part one was last week, so please do listen to that because there's really different information in the first conversation that Charles gave us last week. The Wall Street Coach is my podcast. That's where you can find it, wherever you listen to podcasts. If you're enjoying this conversation, please tweet out to your followers that it's happening right now. We had 300 people in our Twitter space last time waiting for us, and we had a lot of tech issues. So we're coming back, and we have a different focus today. We do have a couple of questions. I'm going to start to add some speakers here to ask their question. Mark Bias, you've been waiting for a while. What's your question for Charles? And thanks for joining us. Unmute your mic. You got it. Great.
Hi, Kim and Shane and Charles. Thanks for hosting this. Charles, I saw your presentation. It was brilliant. I mean, for a lot of us who go through losses, it's real and it's tough to get out of it. I guess my question is, how do you deal with, for example, May and June of this year, where the SPY goes up 5%, you think you're going to get in, it drops 11%, you get in, and then it goes up 5%. This kind of back and forth that really kills your willingness to get engaged with the market.
Yeah, Mark, it's been a tough year. Well, I'm a very contrary trader, so we always feel good to buy when things are up, right? And that's just normal. And when things are down, we're afraid. And I usually turn that on its head. And if something's coming in, but you're in the context of an uptrend or supporting action, I'll try to flip it on its head and buy it when something's coming in, and maybe pair things into the strength. So I'm as a swing trader, that's always what you want to do. But we've been in even though there's been enormous volatility this year, there haven't been that many follow-throughs that have worked, or that where we've had, like, you never want to really get involved in when you're in a bear market and things have broken through support and you're having this crazy volatility without that follow-through day. So that's something that Bill O'Neill kind of made part of his methodology on the general market, where you can have a huge up day, but that's not enough. You need a follow through, like a confirmation of that strength before you dip your toe in the water. So kind of waiting for a follow through day will help you, will kind of prevent you from being in the midst of the tremendous volatility, where it's you're up 5% one day, down 8% the next day, and so forth. But even follow through days fail. So again, you always have to know that when you're entering a market, you're going to take some risk. And early on in a rally, on, let's say, a follow through day, you want to limit your exposure and kind of get your feet wet, but you don't want to put so much out there that if you do have a follow through failure, that you're going to lose another 10% of your account or something. So you start off small early in a rally until things settle. A good market is really one defined by higher highs and higher lows, and you can kind of trust the pullbacks and trust support areas. We haven't really been in that all year until really starting to feel that way now. And it's still, the rally's still quite nascent. We're early in the rally. So, this early part of the year, up until these past few weeks, haven't really offered that kind of higher high, higher low kind of market. And so you want to either stay away from those or trade them really small, because you can trade anything in a small way and not get hurt too bad. And I always have my toe in the market, even if it's a bad market. I usually have some positions on just so that I kind of keep my feel for the market. Somehow when I'm fully in cash, which is pretty rare, you kind of lose your sense of what's really going on. Even when you're losing, having that kind of feeling, that pain is informing you of something. And I kind of like to always have that firsthand feel of what's going on. But yeah, when you're in that extreme volatility, you don't want to be taking big positions until you've had some confirmation that that a new rally may be starting.
Thank you so much, Charles. Diego, I know you had a question and we're waiting for a long time. I don't see you now, still requesting. Stu, I'm going to get you in the room. And just a shout out, last week's Twitter Space and podcast interview with Charles Harris, Stu saved the day for us because he recorded it. So Charles, please, let's hear your question, Stu, for Charles. And just unmute your mic. On the bottom left, Stu, is the microphone. So just, okay. Stu, I don't know if you know you're
Yep.
on now. So
Hi, Charles.
Yep,
Thanks, Kim. Sorry, I've got a bit of delay chiming in from New Zealand.
Oh, that's cool.
Yeah. Hi. Look, I'd like to thank you first for the talk. I found it during a drawdown, and it really did help frame things for me and inspire me. So that was fantastic. My question is in relation to the circuit breakers that you operate under in your professional capacity as a portfolio manager. So that's limits in terms of percentages for where you cut size, and or have to stop trading altogether. Thanks.
Yeah, that's a good question. Yeah, I think it's really important to have some circuit breaker for your own trading, because we all have a tendency to, depending on our state of mind, to kind of break rules or make exceptions, and that can be very dangerous. They say that discipline trumps conviction. So I mentioned in one of those last questions that I think it's important to stay within, in general, if you can stay within 15% of your all-time highs, then you'll never lose too much confidence. It's hard to do if you trade very aggressively and in a concentrated way, and using leverage. That's not easy to do, but even if you can stay within 20% of a high, you can make that back relatively quick if you're in the right market conditions. It's when you start to come off more than 20%, I think you start to kind of enter a different zone where it's like psychologically difficult to come back. And depending on the size you're trading, it might affect you too, just the amount of money. So I don't always do this, but what I would recommend is that if you're off 15% off your highs, you get off margin at the very least. And if you continue to lose, continue to sell down, and just realize you're out of sync, or at least figure out why you're losing. Chances are, whenever I have a drawdown, it's always because the market's gone into a correction. It's rare that I'm not trading in sync. In an uptrend, I'm almost always making money. It's not, I'm usually not out of sync during an uptrend. It's just I'm one of those guys who are a little bit slow to realize when conditions have changed, and I'm always looking at every pullback as kind of an opportunity. But once you've broken through levels of support, and you should always identify those on a chart, and it you need to take a step back. And again, what's been really helpful for me as well is that I log all my trades. So when I'm on, I'll just see lines of green over and over and over. I mean, I might have 50 trades in a row where I made money every trade. But when I start losing, I'll start to see red. In fact, I've coded the cells. So when I start to see those losses pile up, I would like to think that I always have the strength to say, hey, something's different. I need to take a step back. I do have, I mean, I programmed in, even like when I hit, let's say I'm down, I'm not sure what the percent is. I think when I'm down 10%, a message pops up on my computer telling me to get off margin. I don't always listen to it. I have to be honest with you. That's where I need to kind of follow my rules a little bit better. I'm always thinking that, oh well, this time it's going to be different. I've really got something here. But I think keeping within striking distance of your highs at all times is the best way. One, not to lose too much money, but you'll always be in a confident state of mind, and you won't have to regain that confidence, which takes a little bit of time. When you re-enter. So that's what I would do, is just always stay within striking distance of your highs, and I would define that as 15 to 20%.
Awesome. Thank you for that question. Captain Hindsight, what a great name that is, has a question. Make sure you unmute your mic, and thanks for listening in. This will be released next week, everybody. The Wall Street Coach podcast is where you'll get to listen to this again. And part one is already released. We released that about 2 days ago. So be sure to listen to Charles's first part. So, Captain Hindsight, what's your question for Charles?
Yeah, hi. Thank you for taking my call. My question is just, I guess, a little bit technical. I'm sorry if you've addressed it earlier, but I'm a subscriber to one of these services that gives trade setups and so forth. And statistically, they always say that you should take all the trades, every week. Let's say there's 10 trades or 6 trades a day, whatever. But a lot of times I think that maybe if I focused on a few trades, the ones that feel right to me, and went in larger, that would make more sense and I'd have less of a drawdown. I just wanted to kind of see from your experience, your career, kind of how did you go about it, or where did you find the most success? Kind of throwing a casting a wide net and then seeing what works, and getting rid of the losers and holding on to the winners and so forth, or really kind of limiting it and concentrating it more. That's all I have. Thank you.
Okay, that's a good question. Well, as I mentioned, I've always been a swing trader, so I've always, in the past, up until really the past few years, I've traded a lot of stocks and traded a lot of setups. But I think traders spend way too much time focusing on the technicals and not enough time focusing on the fundamentals and building conviction. It's always easy to find a setup. I mean, I can find 20 setups a day easy by running a simple screen. But I can't trade all. I can't put a good amount of money into each of those trades. I need to pare them down to one or two of the ones I like the most. Some of those reasons will be technical. Will be based on, is there accumulation in the chart? Is there something in the chart that I really love that is leading me to believe that this one is going to outperform? So some of it's technical, but great deal of it is fundamental, and not just the sales, the earnings, the numbers and so forth, but I've put a lot of focus into the story. Bill O'Neill would say that you should be able to know within 1 or 2 sentences, be able to explain why something is great and why it should be great. I'm not, my objective is almost never to trade a stock just for the pop. I kind of used to do that many years ago. I would just, I'd be in and out constantly. Now, when I trade a stock, I mean, I actually don't screen every day. I would say I screen about once a week, because once I have a list of stocks that I like, that I believe in, and that I've done the research to build conviction in, that there's a lot of effort that goes into that, and I'll trade that group of stocks until they start to fail, or until a few fail, and then I'll replenish the list, because obviously not every stock you trade is going to be a winner. But I think there's too much emphasis on the technicals and not enough on the research to build conviction on, well, why should the stock work? I will almost never trade on the chart alone. There always has to be a fundamental reason or something in the story to kind of get me to buy a stock, because if you don't really know why you're buying it, like why the company should go up, how are you going to handle it during times of stress or a pullback or even a normal pullback? It'll be very difficult. So I think, there's, is, the O'Neill methodology. We have the general market as one component, one leg of the stool. You've got the fundamentals, which is another leg, and then you've got the technicals. And I think all three are really important to have in line if you're going to put the odds in your favor. So, yeah, I mean, there's way too many stocks out there to, trade all of them. Bill O'Neill would say you can't kiss all the babies. So you should, take it a step further, and of those setups that you're looking at, find out, well, which ones do you really believe in, for a fundamental reason, not just because the chart looks good. I think that's where you'll get your edge.
So we're going to be closing this up with a question or two from Shane. Just reminder, guys, that this is part 2 of Charles Harris's interview for my podcast called The Wall Street Coach. We dropped part 1 wherever you listen to your podcast last week, and this one, part 2, will be released next week. Shane, why don't you bring us home with your last 1 or 2 questions, if you're willing?
Okay. Sure. Why not? So I don't know how many people are listening, are trading the CanSlim system, but it's for me, it's been like a complete life changer. And I saw you speak, Charles, at my master trader program I think it was like 2000 and I don't know, maybe 2006, 2007 in Santa Monica. And anyway, I got to meet Bill O'Neill as well at one of those seminars, which was incredible experience. And just because, the guy's been such a profound, he's made such a profound impact on so many investors. I guess it'd be really cool to sort of just get a few words about Bill and how he's affected you and your trading, and just some of sort of the best things in your trading that came sort of directly from working with Bill and learning from Bill.
Yeah. Bill O'Neill's a rare individual, really an awesome guy. I will say a few things. I was pretty close to Bill. We shared an office. He brought me into his office for a year or two back in the 2001 time frame. I feel like he was really a true mentor to me in many ways. A few things. One, he was the hardest worker at the firm. No one worked as hard as he did. He was always innovating when it came to the newspaper, always changing things around, always thinking outside the box. So the guy worked really hard at his business. He was a very, very optimistic. He says he's never seen a successful pessimist. And so he was the opposite of that. He was very optimistic, but also realistic. He didn't expect us as portfolio managers to always be making money. He was very attuned to the general market and knew that, when that window is open, that's your time to take advantage. And when the window's closed, you want to hopefully not lose too much. But he'd been through enough ups and downs and through enough bull and bear markets to kind of be realistic and know that no trader can make money all the time. There's windows of opportunity, and in those windows, you can make a great deal of money if you're on, and you want to try to avoid those periods when the odds are against you. And with regard to, again, as part of it was this work ethic. He had I think, kind of pivoting off of what I said in the last question, Bill would say that CanSlim is 80% fundamental, 20%, maybe 15 or 20% technical. And a lot of people, associate with Investors Business Daily and with our firm with just technical analysis. And really that's not really the primary component of it. I mean, it's super important to be able to read a chart and be able to see, elements of strength in a chart or elements of support or accumulation. Those are all really important things, but what really drives the biggest winners is a fundamental story and solid fundamentals and growth behind it. So I think people just take for granted like that aspect of it, and they don't research it enough to build that conviction that can help you hold a big winner through some of the ups and downs. Because like Pick and Save was a big stock in the 70s that Bill held for 7.5 years. I mean, my average holding period is less than 7.5 weeks. So if you come across a big winner, like a life changer, you have to know how to handle it differently than all the other ones that we're all kind of associated with fast trading. But Bill made his big money in again a few huge winners that he was able to capitalize on, not trading in and out of stocks. So Jesse Livermore said that men that can both be right and sit tight are rare. So you need to know when you've got something, you need to know how to hold it.
Beautiful. Be right
Awesome.
and sit tight. Shane, any other question before we close up?
No, I think that's it. Thank you so much, Charles. It's really awesome.
I appreciate the opportunity, guys. Thanks for having me on, Kim. And Shane, great speaking with you and getting to know you a bit. It's this has been a real pleasure. I'm happy to be a guest anytime, or if anyone has questions,
Great.
You can forward them to me.
Perfect. Absolutely. We will. And because you shared such a fantastic PowerPoint in the video portion, which we recorded before we came on here, everyone's Twitter space, we'll figure out how to get that PowerPoint to listeners as well. And that PowerPoint is about Tesla and Charles's experience with it over many years. So I'm looking forward to releasing the podcast next week. Watch my Twitter handle for when that drops. Should be probably around Tuesday or Wednesday. Shane, Dorian, thank you for joining both Charles and I to co-host this episode of the Wall Street Coach podcast. Charles, you've come in, given us like over 4 hours between today and last week's interview. You're so generous with your time. You're so generous with your heart and your wisdom. And I'm just so grateful to know you and to have gotten to interview you. So thank you.
Thank you, Kim. I appreciate it.
Everybody have a great night and aloha for now.
Take care, all.